China's economy, once the envy of the world with its explosive growth, is now facing a multitude of challenges that threaten its long-term prosperity. After decades of double-digit growth rates, China's economic engine has sputtered in recent years, with GDP growth slowing significantly. In 2024, China set a relatively modest growth target of around 5%, but even achieving this goal has become increasingly uncertain. Property market crisis. At the heart of China's economic woes lies a severe crisis in its property sector. Once a cornerstone of China's economic miracle, the real estate market has transformed from a growth engine into a significant drag on the overall economy. The scale of this crisis is staggering. The property sector has traditionally accounted for about a quarter of China's GDP, making its current troubles a major threat to economic stability. We can trace the origins of this crisis back to 2020, when the Chinese government introduced stricter borrowing limits for property developers in an effort to rein in speculative behavior and mounting debt levels. While well-intentioned, this policy triggered a chain reaction of defaults among major developers, most notably Evergrande Group. As of now, Chinese developers have defaulted on a staggering $124.5 billion worth of bonds, leaving behind a trail of unfinished projects and shattered consumer confidence. The human impact of this crisis is profound. Estimates vary, but somewhere between 20 to 48 million homes across China remain unfinished. This represents not just concrete and steel, but the dreams and life savings of millions of Chinese families who have pre-purchased these homes, often years in advance. The practice of selling homes before they're built has been common in China, but now it has left countless buyers in limbo, paying mortgages on properties they can't live in or sell. The ripple effects of the property crisis extend far beyond the construction sector. Local governments, which have long relied on land sales as a crucial source of revenue, are facing severe budget shortfalls. This in turn limits their ability to stimulate local economies or provide essential services. The banking sector is also exposed, with a potential wave of non-performing loans threatening financial stability. Perhaps most concerning is the impact on consumer confidence and wealth. For many Chinese households, property represents their primary form of savings and investment. As home prices fall at their fastest pace in 9 years according to recent data, many families are seeing their net worth erode. This wealth effect is contributing to reduced consumer spending, further dampening economic growth. Despite numerous government interventions, including lower mortgage rates and relaxed purchasing restrictions, the property market has shown little sign of recovery. In September 2023, new home prices fell at their fastest pace since May 2015, indicating that the crisis is far from over. The property sector's troubles highlight a fundamental challenge for China's economic model. For years, the country relied on a debt-fueled investment boom, particularly in real estate, to drive growth. Now, as the government attempts to transition towards a more sustainable economic model, unwinding these excesses without triggering a broader crisis is proving to be a delicate balancing act. High youth unemployment. One of the most pressing issues facing the Chinese economy is the alarming rate of youth unemployment. The situation has become so dire that the Chinese government temporarily stopped publishing official data on youth unemployment in 2023, before resuming with a new methodology. Even with this revised approach, the youth unemployment rate for those stands at a staggering 18.8%, more than double the rate in the United States. We can attribute this high youth unemployment to several factors. First, there's a significant mismatch between the skills of recent graduates and the needs of the job market. China's higher education system has expanded rapidly over the past decade, with the number of college graduates increasing from 7 million in 2012 to 10.76 million in 2022. This figure is expected to rise further to 11.8 million in 2024. While this expansion of education is generally positive, it has created a glut of graduates in certain fields, many of whom struggle to find jobs that match their qualifications and expectations. The COVID-19 pandemic has exacerbated the situation. Many of the sectors that traditionally absorbed young workers, such as retail and hospitality, were hit hard by lockdowns and social distancing measures. Even as these restrictions have eased, the recovery in these sectors has been sluggish. Moreover, the quality of education and training was negatively impacted during the pandemic, leaving many young people ill-prepared for the job market. Another factor contributing to youth unemployment is the ongoing economic slowdown. As companies tighten their belts, they're less likely to take chances on inexperienced workers. This is particularly evident in the tech sector, which has been a major employer of young talent. Many tech giants have implemented hiring freezes or even layoffs, closing off a crucial avenue for graduate employment. The implications of high youth unemployment extend far beyond the immediate economic impact. It's creating a generation of disillusioned young people, many of whom are losing faith in the promise of education as a path to prosperity. This disillusionment is manifesting in a phenomena like lying flat or dampening, where young people opt out of the rat race entirely, choosing to do the bare minimum to get by rather than striving for career success. High youth unemployment also poses potential risks to social stability. Young people with limited economic prospects may become a source of social unrest, particularly if they feel that the system has failed them. This is a significant concern for the Chinese government, which has long prioritized social harmony and stability. Moreover, persistent youth unemployment could have long-term economic consequences. Research has shown that periods of unemployment early in one's career can have lasting negative effects on earning potential and career trajectories. This could potentially lead to a lost generation of workers, hampering China's long-term economic growth prospects. Demographic challenges. China's demographic landscape is undergoing a profound transformation, presenting significant challenges to its economic future. The world's most populous nation is grappling with an aging population and declining birth rates, a combination that threatens to undermine its long-term economic prospects. We can trace the roots of this demographic shift back to China's infamous one-child policy, implemented in 1979 to curb population growth. While the policy was successful in slowing population growth, it has led to a rapidly aging society. In just 50 years, China has gone from an average of 6 children per woman to a staggeringly low 1.16 in 2023. This figure is well below the replacement rate of 2.1 children per woman needed to maintain a stable population. The implications of this demographic shift are far-reaching. An aging population means a shrinking workforce, which could potentially lead to labor shortages and reduced productivity. According to some estimates, China's working-age population, those aged 15 to 64, could decline by as much as 23% by 2050. This shrinking workforce will need to support an ever-growing elderly population, putting immense pressure on pension systems and healthcare services. Moreover, an aging population could dampen consumer spending and economic dynamism. Older populations tend to save more and spend less, which could further slow economic growth in a country already struggling to boost domestic consumption. The Chinese government has recognized the severity of this demographic challenge and has taken steps to address it. In 2016, it officially ended the one-child policy, allowing all couples to have 2 children. In 2021, this was further relaxed to allow 3 children per couple. However, these policy changes have not resulted in the hoped-for baby boom. Many young Chinese cite the high costs of raising children, particularly in urban areas, as a deterrent to having larger families. The demographic challenge is compounded by changing attitudes towards marriage and family among young Chinese. Many are choosing to delay marriage or forgo it altogether, prioritizing career development or personal freedom over traditional family structures. This shift in societal norms is further contributing to the low birth rate. China's demographic challenges also intersect with other economic issues. For instance, the aging population is one factor driving the crisis in the property market. As the population ages and shrinks, demand for housing is likely to decrease, potentially exacerbating the existing oversupply in many cities. Addressing these demographic challenges will require a multi-pronged approach. This may include policies to encourage childbirth, such as better childcare support and work-life balance initiatives. It may also involve measures to increase productivity to offset the shrinking workforce, such as investments in automation and artificial intelligence. Additionally, reforms to pensions and healthcare systems will be crucial to manage the needs of an aging population. Debt and financial risks. China's rapid economic ascent has been fueled in large part by an explosion of debt, both public and private. While this debt-driven growth model propelled China to become the world's second-largest economy, it has also created significant financial risks that now threaten economic stability. We can trace the roots of China's debt problem back to the global financial crisis of 2008. In response to this crisis, the Chinese government slashed interest rates and encouraged banks to lend more, funding massive infrastructure projects to maintain growth. This strategy was initially successful, but over time, China became increasingly reliant on debt to maintain its high growth rates. Even as the rest of the world's economies slowed, the scale of China's debt is staggering. According to the Institute of International Finance, China's total debt, including household, government, and corporate debt, reached 335% of GDP in the third quarter of 2023. This is a significant increase from around 200% of GDP in 2008. While international comparisons of debt levels can be complex, this puts China's debt burden higher than that of the United States and many other major economies. A significant portion of this debt is held by local governments and state-owned enterprises. Local governments, in particular, have relied heavily on debt to fund infrastructure projects and meet growth targets set by the central government. Much of this borrowing has been done through off-balance sheet vehicles known as local government financing vehicles, or LGFVs, making it difficult to assess the true extent of local government debt. The property sector crisis has further exacerbated these debt concerns. Many property developers took on massive amounts of debt to fund their expansion during the real estate boom. As the property market has cooled, these companies are struggling to service their debts, leading to a wave of defaults that threaten to spill over into the broader financial system. The high debt levels pose several risks to China's economy. First, there's the risk of a financial crisis if a significant number of borrowers default on their loans. This could potentially trigger a credit crunch, making it difficult for businesses and individuals to access financing and further slowing economic growth. Second, servicing this massive debt burden absorbs a significant portion of China's economic output. According to some estimates, interest payments alone account for about 10% of GDP. This diverts resources away from more productive investments that could drive future growth. Third, high debt levels limit the government's ability to stimulate the economy during downturns. While China still has more policy leeway than many developed economies, its options are more constrained than they were during previous economic challenges. The Chinese government is well aware of these risks and has taken steps to address them. It has implemented measures to curb excessive borrowing, particularly in the property sector. The government has also been working to bring more of the shadow banking system under regulatory oversight. However, managing this debt problem is a delicate balancing act. Aggressive deleveraging could potentially trigger the very crisis the government is trying to avoid. On the other hand, allowing debt levels to continue rising unchecked is unsustainable in the long term. External challenges and trade tensions. While many of China's economic challenges are domestic in nature, the country also faces significant external headwinds that are complicating its path to sustained growth. Chief among these are escalating trade tensions, particularly with the United States and Europe, which threaten to undermine China's position as the world's factory and constrain its technological ambitions. We can trace the current trade tensions back to 2018, when the United States under President Trump initiated a series of tariffs on Chinese goods, citing unfair trade practices and intellectual property theft. While there was hope that these tensions might ease under the Biden administration, they have instead evolved and intensified. The focus has shifted from broad tariffs to more targeted measures, particularly in high-end sectors that China views as crucial to its future economic development. The impact of these trade tensions on China's economy has been significant. According to Chinese customs data, exports to the United States in the first half of 2023 were down by 25% compared to the same period the previous year. This decline in exports to one of its largest markets has put pressure on China's manufacturing sector, a key employer and driver of economic growth. Moreover, the trade tensions have expanded beyond just the United States. The European Union has also raised concerns about China's trade practices, particularly the role of state subsidies in creating what they view as an unfair competitive advantage. In 2023, the EU launched an investigation into Chinese electric vehicle subsidies, threatening to impose tariffs if unfair practices are found. These trade tensions are occurring against the backdrop of a broader push for de-risking or decoupling by Western economies. There's a growing sentiment in many countries that they are too dependent on China for critical supplies and technologies, a realization that was brought into sharp focus during the COVID-19 pandemic. As a result, many companies are looking to diversify their supply chains away from China, a trend that could have long-term implications for China's role in global trade. The Chinese government has responded to these challenges with a strategy it calls dual circulation. This approach aims to make China less dependent on exports and foreign technology by boosting domestic consumption and achieving self-sufficiency in key technologies. However, this transition is proving challenging, particularly given the current weakness in domestic demand. Another external challenge facing China is the increasing scrutiny of its overseas investments and lending practices. The Belt and Road Initiative, or BRI, China's ambitious global infrastructure development strategy, has faced criticism for potentially creating debt traps for recipient countries. While China disputes these characterizations, the controversy has led to increased caution among some countries in engaging with BRI projects. These external challenges intersect with domestic issues in complex ways. For instance, the push for technological self-sufficiency is driving massive investments in sectors like semiconductors. However, these investments are adding to concerns about overcapacity in certain industries and potentially exacerbating debt issues. Looking ahead, navigating these external challenges will be crucial for China's economic future. This will likely involve a delicate balancing act between defending its economic interests, maintaining its role in global trade, and pursuing its goal of technological advancement and self-sufficiency. The outcomes of these efforts will have significant implications not just for China, but for the global economic order as a whole. In the end, China's economic future remains uncertain. While the challenges are significant, they are not insurmountable. The country's ability to adapt and innovate in the face of adversity has been a hallmark of its economic rise. Whether it can do so again in the face of these new challenges will be one of the defining economic stories of the coming decades.